Treasury yields continue to push the bottom end of the range. They've extended the range a few times for a few moments, getting yields down to almost 270, but we sort of revert back to that 275 line in the sand. That's where we've been. And originally when we were trading somewhere way above this level, we thought if we got to 275, it would prompt the shorts to come in and cover and even cause a bit of a squeeze, pushing yields even lower, exaggerating them lower. That hasn't happened, although we have been holding this level, this sub 280, but somewhere in between 280 and 275, the market just runs out of gas. We're unable to see buyers come in, or maybe they're just not willing to come in at this point, knowing that 275 remains a line in the sand, and hence we continue to sit right on that level, albeit somewhere between 275 and 280. That's kind of been our range. I think if we get a move back above 285, it probably starts to see the sellers come back, and if we get below 275 again, I think that we'll probably see the buyers come in, but we haven't seen either of those things in a while for any sustained trade. So right now we're hovering at the 275 line in the sand. And what is that doing to implied volatility? Well, market volatility has been elevated for quite some time, not only in Treasury space, but all across the board. You're seeing the action in equities that gets most of the headlines. You see down 100 handles in the S&P, then up 150, and sometimes in the same day. Like today, we saw a big sell-off in equities and a big rally at the end of the day. So that is keeping volatility players at bay and very busy. I think in the Treasury space, though, it's interesting to note that when we see these wide swings in the equity markets, the bond market seems very unaffected. These aren't fundamental trades. These are technical trades in the equity markets, but you're not seeing the follow-through, sort of the tit-for-tat that we've seen in years past. Stocks go up, bonds go down, stocks go down, bonds go up. We're not seeing that relationship anymore, and I think that's very key here to how this trade is going to develop as we move forward. So right now, volatility remains elevated because, one, we're not sure if where we're going back into the range or making a new range and trading lower yield, or two, how is this whole technical trade going to fizzle out when you're not really trading off fundamentals anymore? I think there's two schools of thought here as to how that goes forward. And lastly, let's look at how this all involves our friends at the Fed. Part of the reason why a lot of this trade is going on is because the Fed fueled risk-taking for so long, but ultimately the Fed wants to raise rates twice in 2019, maybe 3 times, but we'll say 2 to give them the benefit of the doubt. Market's saying, no, I don't think so. Market's looking at maybe a slight chance of 1, but not even 50-50. So you're looking at very small odds of 1 rate hike. I think it's going to be pretty much smooth sailing unless the data tells us different in first quarter that we have to tighten. Yes, they'll continue to unwind their balance sheet at a very slow pace, and that's probably going to continue for some time, but it's really not going to have an ultra big ripple effect on the market. I think right now the focus remains on the elevated market volatility, the global growth scenario, which has been played out many times, and some of the changes that are going to happen in 2019, which include and are on deck, including Brexit, which no one really knows how that's going to go because there is no plan and there really isn't any sort of resolution in place. So as we look at the bond market, yields are stubbornly low. As we look at equities, volatility is stubbornly high. And somewhere in between there, we're going to find a trade. But right now, it seems that risk takers are taking a step back as the algorithmic traders have their day in the equity markets.